Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, December 6th, 5:41 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market. So Friday when I did this, I was talking about next week. If we have some more strength, we can get off a bear market rally and change it to uptrend. And 2 days later, we've done basically a complete 180 and changed it to a fading bear market rally. Another red day in the market. All hope is not lost yet. I'll talk about why I feel that way, and we'll go through a bunch of charts. So over here on the trend gauge, market leaders weakening. Yellow arrow has come out as about 5 or 6 broke below the 21-day exponential moving average today. That's the feedback that we look for. What's happening to leaders. If they start to fade, the market can't make progress. That's a well-known Jesse Livermore quote. If you can't make money in the leading issues, I think he called it at the time, the leading issues of the market, you won't be able to make money at all. Short-term fading also, arrow moving closer to neutral. We'll take a look at the charts and you'll see why momentarily, but the bad news is the S&P 500 got its first close below the 21-day exponential moving average today. Medium term still at green, firmly above the 50-day for now. Long term, red arrow, showing that neutral is fading back toward bearish. Really ugly last couple of days. Basically, we undid all of the gains from the Wednesday, which now looks like a short covering rally on, and it was a violent one, a short covering rally on Jay Powell's interview. Since then, more market data has come out, and that data has led to the market, at least, to conclude that the Fed's not going to reduce their interest rate, stop hiking interest rates, because inflation's not coming down based on that data. So what just happened today? Growth lagged badly across all market caps today. S&P broke below the 21-day exponential moving average. So large growth. Let's take a look at these numbers. First of all, G6 down 2.31%. If you don't think the G6 is useful, year to date, the G6 is down 40.76%. This tells you all you needed to know about getting involved with growth stocks in 2022. So the S&P down 1.44%. To break that down, the growth part of the S&P was down 1.9, value down 1. NASDAQ 100 down 2.07. Dow Jones Industrial Average down 1.03, mid caps down 1.1. To break that down, the growth half down 1.6, value half down 0.8. Russell 2000 down 1.5. The growth half down 2%, value half down 1%. 60/40 global diversified, stock and bond down 0.53%. In-house GROTECTION losing less than the S&P. That's not what we're wanting to do. More stops got triggered today. Our hedges did their job partially, and we'll go over what we sold, why we sold it, and talk about some position sizing metrics, but down 1.25%. We'll hit the tail of the tape and charts of interest. Let's quickly discuss what we do here at Revere, the public service announcement. So we're active market trend followers. When the market is in an uptrend, we are fully invested in the market. That's when we're trending above all 3 time frames that we mentioned on the prior page, the trend gauge. We look at the 3 time frames: short term, medium term, long term. Short term is the green line, medium term the red line, the black line is long term. We start to turn sideways and roll over, our stops will take us out of the market. If we really start to sell off, the slopes of the lines will roll over. If we get below the black line, that's the 200-day moving average. That's when we are understanding that we're in a heap of trouble, because all bear markets take place below the 200-day moving average. This is when we get to a maximum defensive position. Then we have some short-term indicators that get us back into the market to participate off of the lows, always with an eye toward the 200-day moving average. And the bad news is we got above the 200-day moving average 3 closes last Wednesday, last Thursday, last Friday, broke below it today, broke further below it today, and also broke below the green line, the short term. We've basically cut our exposure in half since the market closed on Friday. And we'll go over that when we go over the tail of the tape. One of the reasons why we're still sitting on basically 0.6 beta, which is equivalent of about a 60-40 portfolio, is the 150 and the 100-day moving averages are right below today's close. We undercut them and got back above them. We also undercut and closed basically right on, very close to this 39.50 area. If you'll recall, there were 2 levels of support that I had been discussing. This 39.50 was the support level here back when we had this first move off of the lows on a favorable CPI report. We battled back and forth around this 39.50 area. When we pulled back to 3900, that held. So there was a 39.50 level, a 3900 level. We broke below 39.50 today. We got to where the 150 and the 100-day moving averages were around 39, 20, 25-ish. Let's see, 39, 31 in this case. And we bounced. So don't want to blow everything out just on one close below the 21. Also, I've learned too many times that one close below the 21, you very frequently reverse back up the next day. Now, there's been a lot of selling the last couple of days. All you got to do is look at this 5-minute chart and see this is basically a 2-day frozen slope trend lower. We bottomed late afternoon yesterday, rallied a little bit into the close. We bottomed late afternoon today, rallied a little bit into the close. This was a reasonable support area. This is also a reasonable support area. But we really need to get back above this 39.50. You can see where it held today. It held 3 times here, here, and here, and then it finally gave way at 12.20 today, break below, and then we just trended lower. So the 39.50 is a real line in the sand. We want to see if we challenge it tomorrow or overnight. If we can get back above it, that'll be a big feather in the cap of the bulls, meaning we're trying to put in a low. And also note that the 21-day is at 39.60, so a little bit higher than that, 39.61 actually right now. So I've been pointing 39.50 to 39.60 as a support area. We broke it. Sometimes you just spend a day below and reclaim it, in which case it makes it a false breakdown, and then we see what the next level is that we can tackle higher. So that's where we stand on the S&P 500 now. Let's go to the NASDAQ 100, which continues to be the weakest of the indexes. Couldn't get above the 150-day moving average last week, not to mention approaching the 200-day. Broke below the 21 today. Again, one close below. Broke below that key fib, that 286.82 that we've been talking about for a while, and now only 1.7% above the 50-day moving average, which is flat and slightly rising now. Let's look at the strongest of the indexes. This is the Dow. Did break below 34,000, but undercut and closed right on the 21-day exponential moving average today, so a little bit of a good sign there. Note the relative strength late last week and early this week as it's losing less than its other big cap counterparts. Mid caps MDY, I talked about my concern yesterday because of the big financial and energy components in here. Energy got beat again. Financials were down, but not as much as the market. And this bounced at the 200-day moving average. So we're trapped on mid caps between the 21-day and the 200-day. No relative strength lagging recently, as I pointed out last night. And then small caps, also very weak, broke the 200, 2 closes now below the 21, sitting right on its 150-day moving average. So not a total breakdown yet, very clear weakness, but when I do the day count, I counted these 2 days up here, consolidating near the top as consolidation days, not down days. The last 2 days very clearly down days, but this also means if you include those, that's 4 red closes. That's not that's a lot of red. And another reason why we don't want to sell everything out of the portfolio, although some stops did get hit and we hedged but are still holding on to our S&P 500 longs. We'll go through that when we go through the focus list. So those are the major indexes. Let's look at the even weighted indexes very quickly. RSP, S&P 500, sitting on the 200-day moving average. Undercut reclaimed it. Also, the 21 is right there for RSP. QQEW, down 1.5% today, broke the 21, sitting on its 150-day moving average. Note it did get above the 200, and those big NASDAQ 100 stocks, man, if they ever stop selling off and they start accumulating them again, the indexes can really fly, but it feels like we've been saying that for a while now. Let's take a look at the dollar. Dollar started out weak today, but got progressively stronger, inverse to the market. So basically it's held the bottom of this range now. Still an oversold, so it can move higher quickly, but holding on to this bottom of this range right now doesn't want to seem to go much lower. The declining 21 is coming down to it. Let's take a look at the VIX. The VIX, I've been noticing on the VIX, it really does kind of seem to hang either above or below the 21-day exponential moving average, and it's been below it for a while. Bounced off it for the second time since this downtrend. So a little bit of a divergence. You got the S&P closed below the 21, but the VIX stayed underneath the 21 here. So a little bit of a positive divergence there. Above today's highs, we'll get it above the 21, and that would be a negative for the market. Also note, coming off of oversold, this could run higher quickly. If it does, we're positioned very well with our shorts and our stops, and the longs that we have that are holding up better than the market. So as always, we got a plan for either case. What else we want to look at? We want to look at bonds, 0TNX. This is the 10-year. Prices were up today, which means yields continue to fall on oversold near the lows of last week. And the 30-year yields again higher on or lower as the price is higher. Very strong downtrend in interest rates and in oversold territory for 3 weeks now. Let's take a look at gold. Kind of did the opposite of what the dollar did. Started out strong and faded as the dollar started out weak and got stronger. So for now, gold could only have one close above the 200-day moving average and now faded for 3 days. So it's trapped beneath the 200 and the 21. Lots of things to keep track of here between the 21 and the 200. And eventually they resolve and turn into a trend, a strong trend that can be played. And this takes care of all the paper cuts when we get it. Bitcoin kind of flat on the day, continuing to consolidate near this right around 16,000 in the true price of Bitcoin. Let's see what I think that those are all of the tickers that we want to cover. So let's bring up the tail of the tape now. Not a lot of changes here, except now we've got the stochastics negative on the indexes, the G6 and the NASI RSI rolled over also. Put call at 1.05, VIX at 22.17. That was up 6.8% on the day. Fear and greed down to a 60, still operating under this, just one close below the 21, but really we're going to change this to neutral. We need that second close below to get off of the bull and into the bear case. So we'll call that neutral now with one close just below. A little bit of news at a CNBC CEO roundtable. Basically, all the executives were prepping for a recession next year. The one exception was airlines. They said if we hadn't been listening to the news, we wouldn't understand that there was a recession going on at all. In fact, several of the airlines ordering additional planes and hiring staff. So maybe this is just a recession of the middle class and lower class, and the rest stay strong. You are seeing signs of expensive retail, quality retail stocks holding up pretty well. So day count from down 1 to down 2, that's really down 4 if you count the 2 red consolidation days. Expectations coming into the day were neutral since we broke the 200 yesterday but stayed above the 21, now negative with the break below the 21. That's the 39.50 support level also. And this 286.82 fib retracement continue to play ping pong back and forth along there. 5-hour frozen slope today, a little bit of a bounce into the close for the second straight day. You can see the ranges. The only thing strong today, gold, silver, and gold and silver stocks overperformed. Yeah, they were positive. Silver was flat. XLU was the only green sector of the 11, and bond prices higher, which means bond yields down. Dollar started lower, ended up higher. Oil started higher, ended up lower. Biotech, TAN, solar got hit really hard today. XLCKY, those are the 3 tech components of the S&P 500. They were red along with semiconductors and software. Here's our focus list, mostly made up of what we own. We got stopped on 2 holdings today, sold half of our Boeing, and added to a hedge 10% SDS. And then we want to look at Apple and Tesla, which really aren't helping anything. So that brings our volatility adjusted beta down to 0.6, which is basically a 60-40, 60% S&P 500, 40% cash equivalent. Bottom line, growth lags across all market caps. S&P 500 breaks below the 21-day moving average. Let's get to the focus list now. So I want to show this this template that we use in-house. Basically been looking at a lot of stats lately for wanting to know what is a typical growth stock look like. So downloading a lot of data off of MarketSmith, we kind of had an idea, but I wanted to quantify it. So basically the average, quote unquote average, 21 over 21 candidate, IBD 50 candidate, basically has about an ATR of 5.5%, and with the SPX ATR at 2, which is kind of where it has oscillated around 2, sometimes higher, sometimes lower during this bear market. That's 2.75 the ATR of the S&P 500. The average beta is about 1.5. That gives us a Revere volatility factor using 20% of the beta and 80% of the ATR at a 2.50. So basically, our baseline score for a growth stock is 2.50. And this is the example size that we use for our initial buy. The initial buy at 2%, this would be about a quarter of a position. And for example, if the buy was 100 and -1 ATR stop, would be 94.50. That would be a 5.5% loss. So basically our R, or what we're risking on this first buy, you've heard me mention, we used to have 0.25. After our deep dive in early 2021, we lowered it to 0.2. With the latest stats that we have here, a half position would be 0.22, a quarter position, basically our first buy. And if the first buy doesn't work, we're out. And that's what we got stopped on today, is a couple of quarter position sizes, and the loss was minus 0.11% of the overall portfolio. So this is the guideline we're using for setting the stop of our first buy. The V1 size can vary a little bit depending on what the volatility of the ticker is that we're buying relative to the S&P 500, but we don't want to lose more than 0.11% on that individual buy, and then we pyramid based on certain gains, a quarter of an ATR, a third of an ATR, a half of an ATR, and up to 1 ATR from our buy, and then we set our R targets to take partial profits at least 2 R. And that's the math behind it. So let's go into what we got stopped on today. So S&P, when it broke below that 21-day moving average, that's when we added on the SDS. And until we get that second close below and a lower close below the 21, we still have that SPXL with basically the hedges that we have are offsetting 75% of that long. That SPXL 19% position is what we have now. So what did we get stopped out on? We got stopped out on BA for a minus 0.11% loss on our, this is our on our pyramid buy. We're mildly negative on our first buy on Boeing. Pulled back, lighter volume. Okay, market weakness is really what's the reason for this sell. We got stopped on ANET. Also setting the stops, we've been shrinking the position size. That's how we arrived closer to that 2%. And want to make sure that it's a clear break of the 21, not a marginal break before we get stopped out, because that's what's happening in this type of market. Weakness is turning around to strength very quickly, and having a stop too tight on too big a position size just means you'll get chopped up. So ANET, clear break below the 21 and close below. So we close that out minus 0.11% on that also. First Solar got back into this after some extreme strength last week, this big volume day. Not so much anymore. Solar's, let's look at TAN. This got really hit hard today, down 3.43%. Below the 21, end phase got demolished. Failed breakout on end phase here, sitting on the 21, down 7.8% on the day. But First Solar stop hit, 2% size, minus 0.11% loss. So those three stops out combined a 0.33% loss versus the overall portfolio. Let's get into what we're still holding now. We still have the first buy in Boeing. We still have Netflix. And these are holding up pretty well. 3 days up on volume in Netflix, 2 days back on lower volume. It's what you've been seeing with Netflix, up on bigger volume, pulling back on lighter volume. Steel Dynamics had a nice day today, up 1.43%, near all-time highs. Great relative strength on Steel Dynamics. PI, one close below the 21, but we had profits before, so we haven't hit our, we're still slightly positive on this. We haven't gone negative. We had some gains on it, 4 days back, one close below the 21, but still positive on PI, so not stopped out there. FIVE, haven't hit our stop on our first buy here. Also finished off the lows, lower volume pullback after this really big volume move up on earnings. Trying to hold on to this, but the market may end up pulling us out of it. CELH continues to act like a leader, up 0.5% today in a very red tape. Mobileye continues to be extremely volatile. Still holding above its pivot, but really multiple stop outs. And this is, again, another example of why I don't think you can just use these standard 7 to 8% losses when you've got a stock with an ATR of 8-9%. So there's Mobileye, and then we're long our hedges. SARK, which is inverse, ARKK, profitable, firmly profitable on this, and FAZ, which is long, the inverse 3 times XLF financials. So you'll note financials broke the 21 yesterday, very much lacking relative strength recently. A little bit of strength toward the end of the day on this, and you'll notice that they were down less than the overall market, but continued sell-off today along with the market did bounce back. So those hedges, as I said, all of our hedges in total are offsetting about 80% of our index long in SPXL. The remaining percentages of the stocks that we have here and that long put our beta at about a 0.6. And the key thing for tomorrow we'll be watching is the behavior relative to the 21. Mildly, well, getting into pretty much oversold territory, and we're around this 100 and 150 day moving averages and still above that 3,900 area in the S&P. 3,900 is really the ripcord if that gives way. So that's going to wrap it. As always, love to hear from you. You can email me, don@revereasset.com, or my partner, Danny Stewart, dan@revereasset.com, or the phone is 855-REAL-WEALTH. That's 855-732-5932. Remember, this chart, it's not how much you make, it's how much of it you can keep. There are paper cuts and risk involved in getting back in on when the market looks like it's trying to put in a bottom, but we really don't put the pedal down until we get above and stay above the 200-day moving average. That's what makes a strong trend. We were 16 days above the 21-day exponential moving average until it broke today. Will it be a one-day break or a multiple-day break? We'll be keeping an eye out tomorrow. So wrapping up Tuesday, December 6th. This is Don Vandenbord, Just the Facts here at Revere, telling it like it is. It's not always a good story, but it's the truth, and you have to respect price and volume. Those are the only two truths in the market. Thanks for listening. Have a great day.